not interested in what you see in the financing tool. I'm not interested in. My partner, who's a managing director of Wells Fargo Securities. Darren, do you want to talk a little bit about what you're doing with your institution?
Sure. So I'm
interested in what you see in the CMBS world,
except with the express written permission of Major League Baseball and the individuals on the panel. First to my left is Darren Esser, who's a managing director of Wells Fargo Securities. Darren, do you want to talk a little bit about what you're doing with your institution?
Sure. So I run our commercial real estate CLO business. We've been fortunate.
Talking to the mic.
We've been fortunate to be a leader in the space since, well, I guess in the last 22 months, we've done 11 transactions, static and managed vehicles. We look to structure transactions that are certainly transparent and investor-friendly, that offer good relative value for the investor universe while providing attractive financing, reliable financing for commercial mortgage originators and issuers.
I think next Darren is Gene Kilgore, Executive Vice President at Arbor Commercial Mortgage.
I run our securitization platform, our capital markets platform at Arbor, and we have a public company and a private company. Public company is a bridge lender, and most of our borrowing through that entity is via CRE CLOs. We've done a total of 8 since 2004. And in our private company, we do, among other things, we have an agency multifamily business, predominantly Fannie Mae and Freddie Mac.
My partner, Jeff Rothblatt. You don't know who it is anymore? Jeff, I think it's okay. You can leave it down.
I work here in the capital markets department, and together with Stu, do a lot of work on commercial real estate CLOs. We also do a lot of CMBS. In the CLO space, we represent issuers and underwriters, and we've been very active. And we were very active in what people refer to as the CLO 1.0 market, and we've been very active in the 2.0 market, trying to work with issuers and underwriters and bringing the product back to market and making sure that they are a successful product.
Next to Jeff is Chuck Lee from Director Credit Suisse Securities.
Hi, yes, my name is Chuck Lee. We are around 2 years into the restart of the commercial real estate platform at Credit Suisse. I oversee the securitization operation, which includes principal and agented transactions, as well as our warehouse financing platform. This sector is one that is on sort of our next to-do list in terms of priorities. We have brought a handful of issuers out to market over the past couple of years, continue to remain involved not in this sector, in our primary sectors of principal origination and securitization, but third-party business with NPL issuers that still actually come to market from time to time, the agency guys, et cetera.
Next to Chuck is Joan Sappensley from Resource Real Estate. Joan?
Thank you. Resource Real Estate is a public mortgage REIT, Resource Capital Corp. We originate our loans directly, and we service them all ourselves. We don't outsource anything. We are externally managed by Resource America, which is a $20 billion asset manager. We have a dedicated team of 15 people that only originate transitional bridge loans for the REIT. We have done 6 CRE. First, we did 2 legacy CDOs, and now we've done 4 CRE CLOs. Since 2013, we have done about $1.3 billion in 4 deals of this iteration of CRE.
Thanks, Joan. And then finally, we have Kunal Singh, Managing Director from JP Morgan Securities.
Thanks, Stu. So,
you want to talk into the mic, Kunal?
Kunal Singh, I oversee the securitization and execution efforts at JP Morgan for all CMBS, both principal business and agented business, which includes CRE CLOs, where we've been quite active over the past 12 months in particular, but really
since the market reopened back in 2010. We've been a leader in cutting-edge type of executions for different types of performing, non-performing, and then we have a active and growing financing business that sometimes results in CLOs, but a lot of the stuff we provide is bespoke solutions to clients who have varying types of needs with cash flowing and non-cash flowing assets.
Thank you. I appreciate all of you being on the panel. I'm Stu Goldstein, your humble moderator. The topic is really dealing with broader than just CRE CLOs, but other securitization and finance alternatives for bridge loans. I thought it'd be worthwhile to ask Jeff in 5 minutes or less, so that we don't lose the audience, to talk about really what the structure of a CRE CLO looks like, so we know what the difference is between that and a traditional CMBS deal. I'm going to try and press this button.
Sure. Very generally, when we talk about a frequent question that I get is, what's the difference between a CMBS and a CLO? Essentially, at their core, they're both commercial mortgage-backed securities. They're both securities that are backed by a pool of commercial mortgage loans or similar types of interests. The difference in the nomenclature essentially relates to the different legal structure that they take on, and over the course of the evening, hopefully we'll have an opportunity to talk about some of the nuances and the advantages and disadvantages of the different structures. But in particular, what the structure that's used, and we'll refer to as CLO, is a structure where the issuer is essentially a corporation that's issuing securities, and in particular, those securities are debt securities or notes. And the reason why that's important is the CMBS world, you might be familiar with pass-through certificates. In the context of the CLO, because it's a corporation, it's issuing notes. The notes are going to can be denominated. As you see in the diagram, they can be tranched, just like in a CMBS transaction. But the legal structure is that of debt, and therefore it comes with payment dates, maturity dates, events of default, liquidation. And that can impact the structure, the characteristics of the notes, as well as some of the flexibilities and some of the things that the issuer can or cannot do while it's holding the assets. The deal parties should look familiar to you because they are relatively similar to what you'd see in a CMBS deal with a loan seller, an issuer, trustee, servicer, special servicer, collateral manager. Some deals have that, and that's something that we'll hopefully have a chance to talk about this evening. Advancing agent, placement agent. So in the broader sense, it is similar to a REMIC or a pass-through type of a deal, but because it has a different legal structure, it's done as debt, it brings along a number of different features and nuances that we'll get into.
Thanks. One thing I am going to do is I'm going to encourage everyone to ask questions. If you've got a question, let's make this an interactive panel. We're lucky that we have a large number of panelists. So if you've got a question, please go ahead. I promise not to talk over, well, I don't promise, but I'll try not to talk over our panelists when they're going ahead with an answer. The first question is really to start the panel off with, what is a bridge loan when we're talking about bridge financing versus just, let's say, a CMBS floating rate deal or a conduit deal? Kunal, can you define a little bit of what we're talking about and the types of assets that are going into these transactions?
Sure. I think there's a number of ways you could answer that question. I mean, the way I'm going to choose to answer that is by just throwing out a few numbers. You know, a bridge loan is obviously a transitional loan. There's a transition cash flow story. If you look at the spectrum of CRE CLOs that are out there, you will see bridge loans that have as-is cash flow debt yields anywhere from mid-5s to low 8s. That's kind of what you're looking at. And I kind of think of it as shades of gray. So you've got bridge light loans where they're pretty stabilized. You may have a sponsor who's buying a multifamily property, needs some sprucing up, small capital injection, already 93% occupied. They think they can bump rents up 10% over the next 12 months after they put the capital investment in the asset. That's a bridge light loan. Take the other end of that, a 6% or 5.8% debt yield, 50% occupied office building, very well located, but it's an asset that needs to be repositioned. You have a sponsor that comes in with a much more elaborate plan to put in $30 a foot capital in that asset. That's a 24-month, 36-month turnaround where they're going to get that thing leased up to 85% and bring in a couple of new anchor tenants. That's a much more transitional story. You will see both types of loans in CRE CLOs, and I want to kind of compare that maybe to fixed rate conduit, which a lot of people know, where you're looking at stabilized cash flow assets generally that are anywhere from 8.5% debt yield would be a lower cap rate asset in a better market, all the way up to 10.5%, 11% debt yield, although the averages right now are probably in the mid to high nines is where conduit is. And I think the challenge, or the interesting thing about bridge loans for an issuer and for the banker representing the issuer is the process with the rating agencies, process with the investors. The rating agencies are obviously, they like cash flow. They like cash flow today. And so to get a bridge loan deal, which is predominantly those fixed debt yields rated, you're going to end up with a worse answer, just because obviously the more credible the business plan, the more you can tell and convince the rating agency that this business plan is going to work, and here's why. You get a little bit of upside for that, or some credit. But generally, they're raters of as-is cash flow, and you'll see more conservative structures. And then at the back end, when you're out marketing to investors, it's a similar theme. Your bar is much higher. Burden of proof is much higher. You're trying to sell deep credit stories, and you're asking a lay buyer who doesn't know who you are that, okay, you're going to take risk on this. And obviously that, again, is incumbent on both the issuer and the banker. The more track record the issuer has, history of performance and other things, those are all things that come into play. And that's
so how do these compare with the large note floaters? We see floating rate deals that are being done in CMBS.
Yeah, so just size? That's a good question. So JP Morgan is, without question, the leading issuer of pooled floaters in 2.0. There's a couple other banks that are involved, but we've by far been the most prolific. And I would say the general characteristic of the floaters we're originating is they're much more on the bridge-like side. I wouldn't even call them bridge loans. The most common question I get from investors on our pool floaters is, why isn't this fixed? Because those are loans that could be fixed, maybe should be fixed, but the sponsor, for whatever reason, the position strategy, hold period, chooses to take a floater. They may think LIBOR is staying at zero. They prefer that. And so the floaters we're doing are much more stabilized versus what the big broker-dealers are doing pre-crisis. I wouldn't really compare them that much to what most of the CLO issuers are doing.
So Joan and Gene, from your shop's perspective, when you're looking at these loans, are you seeing any trends, or what kind of loans do you look at? I don't know that the product is necessarily the same between Resource and Arbor, but what are you seeing and what are you looking for?
Yeah. Can I respond to something that Kunal said?
We have 30 seconds.
Is
it going to be that JP Morgan is not the leading, the premier?
Definitely not. I would just like to draw a distinction between large loan floaters and CRE CLOs, which is that those of us who issue CRE CLOs are keeping something like 20% of the deal. We are viewing it as a financing and not a trade. And I think that's a huge distinction. I'm not
that's fair. I was talking more on loan level, but that's fair.
Okay.
And Joan, one other thing on that, the pooled floaters, the first mortgage component of those deals are relatively low leverage and have very attractive debt yields, but generally those entire capital structures of those properties generally have mezzanine or B notes below it. So when you aggregate the entire debt on those loans, in many cases they're more levered. Last dollar of leverage, yeah, that's right. They're more levered than loans that go into CRE CLOs, and I think investors certainly are aware of that. And I also think it's important to highlight that in a CRE CLO, the repayment. So when a borrower pays off the loan, all the proceeds of that loan are used to delever the capital structure in a static transaction, sequentially. Sometimes, some structure, static deal, in a static deal, right? You see all the cash runs through to the benefit of the most senior outstanding class, and it's paid sequentially. In the pooled floaters, when those loans pay off, there effectively is pro-rata distribution outside of the trust, the mezz or B note class. So it doesn't build the OC or subordination in the same facet as a fully sequential transaction does. Yeah, I think in fairness, you're just saying there's more dollars of leverage that would be applied if all the leverage is on the mortgage loan versus being the manager.
Right, because it gets
the mezz holder outside of it.
Understood. But the point would be in the structure, right, that you've got less leverage in the deal than overall.
Right.
But you're right.
Higher loan
Correct.
structure.
You're right.
I would just say that the question I was responding to wasn't so much the structure of the deals, but the profile of the cash flow.
Understood. We'll get into the structure a little bit more, and I think taking it outside of that is difficult to relate to. So, Joan, back to you and Gene on kind of what these loans look like and the characteristics of the loan. Is there something we're seeing in trends? Are we seeing more construction or land, or what does a transitional loan or a bridge loan look like?
For us, we've always specialized in what we call lightly transitional bridge loans, and we're not changing. As we get more entrants into the business, we do see people that will reach for a lot more risk than we're comfortable with. I think, we have seen, even in the loans that we like to do, sort of compression spread. But we're not, again, joining that rate. So I would say those are the changes that we.
You do see a few more market entrants who are looking there. It doesn't affect what you're doing with your product. Maybe that there's a little bit more entrance on the transitional heavy or transitional moderate versus transitional light.
Maybe, we also see, Fannie and Freddie have announced they're going to do more transitional lending, and we do a lot of multifamily. It does even more. So that will probably affect us in the future. It hasn't yet.
Dean, you want to talk a little bit about that, maybe? We just trends, period.
We do probably 75-80% of our business, probably 80+% today actually, is multifamily. Bridge, bridge to us means a lot of things, but I guess we predominantly do bridge light as well as Canal defined it. We will do something with more moderate to heavy transitional component as well. We certainly do those deals and like them from time to time, but as a percentage of what we do, it tends to be more of a bridge light program. An average loan is probably outstanding from 18 to 30 months. They're floating rate, they're LIBOR-based 1-month floating rate loans. Spreads are probably from low 400s to mid to high 500s today, something like that. On the average, it's probably high 400s to 500 over LIBOR. That's definitely been a trend that's been down over the last 24 to 36 months, which would surprise no one. I don't think we've seen too much of a compression in spreads over the last 9 months. We've probably seen a bit. There definitely have been new entrants into the market. I think there have been more people who want to enter it and actually found it feasible to do so. I think one of the things that we've really seen, I would imagine Joan has seen this as well, is that if you don't have a real platform, there are a lot of borrowers who really are reluctant to borrow money from you. We find a lot of our borrowers are not as sensitive to pricing. They're not trying to get the last 5, 10, 20 basis points out of pricing as they might be on a CMBS execution. They're trying to maximize proceeds and minimize their cost. I think a lot of borrowers on the bridge side, at least that we see, are really interested in certainty of execution and knowing who's going to service the loan, knowing that you won't retrade them on the docks, that you'll close a loan and you have the ability to close it if you issue a term sheet. So we are seeing more competition, but I think if you have a platform that's regarded as sustainable, I think it's a big competitive advantage, and I think a lot of borrowers were really saw the downside of that, from late 2007 through 2008, 2009. So I think that we find they're more increasingly focused on that.
Well, let me throw this out to the underwriters then, because that's a really good segue. Both Jeff and I and the underwriters get paid by people doing these deals, people in Joan and Gene's position. So we're chasing deals. How come we haven't seen the rush back to CRE CLOs that I think maybe we expected? One person goes out with a deal, everybody wants to do a deal, and I think we saw from 2005 on a lot of new entrants that Gene was talking about and Joan alluded to in her answer. Darren, why do you think, and Chuck and Canal, why do you think we haven't seen as many deals happening or deals sitting around a bit more?
Sure. I think
there's really two major reasons. One is rating agencies have become very conservative in how they look at pools of bridge loans in a securitization. Moody's in particular is really the major rating agency that is involved in the space, and they are a very strong governor on effective advance rates, investment grade advance rates. Their advance rates are much more conservative than where they were, for instance, in 2006. Today, if you look at Moody's methodology, which is very transparent, the guys at Moody's do a good job. If you look at their methodology and you run a pool of real high quality bridge loans through their methodology, best case investment grade advance rate, best case, is low 70s, 70, 71, maybe 72% investment grade proceeds. Took a time machine back to 2006 with a similar pool of whole loans. The leverage would be 90 to 95% investment grade. Do you have a time machine? I don't. All right. So you're going from 2.5 turns of leverage. I'm sorry, you're going from 9 to 15 turns of leverage to 2 to 2.5 turns of leverage. So that's a huge difference in how these deals get done. So the quality is much different, much better. Certainly, you could argue that Moody's is being too conservative, and certainly, I think everybody agrees the rating agencies are too aggressive during the last cycle. But I think the pendulum certainly has swung a little too far. The other thing to highlight is, then you're comping those advance rates to warehouse lines, and generally, warehouse lenders are somewhere between 70 and 80% advance rate. So, Moody's is in many cases more conservative than, for instance, Wells Fargo on what they're willing to put investment grade proceeds on. So that's certainly a big issue. And then certainly cost of funds and structure is another big issue. Generally, the market over the last 2 years generally has been a static market, the exception of Gene's deals and a couple that we've done. It's generally been a static market, so not a managed market. And the structures are sequential pay vehicles. And in a static transaction, when the loans pay off, obviously those proceeds are going to be used to deleverage the capital structure sequentially, and you're paying off your cheapest source of financing, and you're also deleveraging quickly. So in order for a static vehicle to make any sense, you have to have call protection. And generally, bridge loans have light call protection. So you need to be able to originate a pool of loans quickly in order to have adequate call protection so that you can come to market quick enough to take advantage of that call protection. Because if you get prepaid without it, you're obviously the issuer's returns would suffer pretty dramatically if they get massive payoffs. That's been a big issue for static deals and aggregating enough collateral that has the call protection. Managed transactions certainly would address the issue of prepayments, but the market really hasn't accepted managed structures in any source of volume. And I think the market generally struggles there with pricing. Those deals just aren't competitive. They can get done, but the pricing and the levels that issuers would have to put on those bonds to sell them are certainly, in many cases, unattractive.
I would say that Gene is showing remarkable restraint at this point. We'll give him an opportunity. Chuck, UTS offers both warehouse lines, and banking.
I mean, my brain kind of works in a little bit more of a simplistic kind of fashion. I broke it down into three kind of components when I saw this question come up. And, first I would categorize sort of the first component as sort of lender focus. When the market came back in CMBS land, right, securitization came back as a technology, and, there was a major bank that came out with a paper that said there was going to be this massive wave of CLOs. It might have been 3 years ago or something, and it never happened. Not all lenders
we're playing in both spaces, but certainly the lenders that we're trying to rebuild sort of a primary basic CMBS operation, we're more focused on actually building that for the first couple of years and not focused on floating rate transitional. The second bucket in my mind was simply financing alternatives. And so, Gene mentioned, borrowers for light transitional, moderate transitional, heavy transitional, and that those things mean different things to different banks and different specialty finance shops. The borrowers for these complicated loans at times, want to have somebody on the phone that they know and have known and can trust to, call and contact when they need another draw, when they need to, get an approval for a new lease or something like that. And then the lender financing alternatives, the guys that have the access to balance sheets, right? And they have no capacity constraints. They have no mark-to-market or request provisions at times. There's no need to access the capital markets. As capacity goes down and they need to either increase line, caps or otherwise, then maybe that would be an attractive exit. And then the third would be everything that Darren kind of walked through. I 100% agree with, which is agencies and pricing. Agencies that were very slow to come back, and to be fair to Moody's was one of the first to come back to rate these types of vehicles. Others were slower to do that. And then when they did come back, absolutely, they were very conservative. And on the investor side, investors were pushing back against the old structures. They wanted credit pools that were discrete and that could diligence and approve through their committees, and that's slowly evolving. And Gene's been at the forefront of that technology for a few years now. Very successful at getting those types of managed vehicles done, and so hopefully that's the next stage. But that's kind of how I've always broken it down.
No, I promise you won't be last on all the questions because it puts you in the difficult position.
I think a lot of I agree with a lot of what Darren and Chuck said. I mean, I would kind of break it down pretty simplistically too and say that, coming out of the crisis, the CRE CLO 1.0 model was, viewed by a lot of people as broken. A lot of those deals went bad. There was a lot of liquidations, a lot of bondholders took losses. The agencies were obviously retrenching. Coming out of the crisis, there was a ton of repo financing available to a lot of the guys who are doing these deals right now. Attractive terms, advance rate, financing costs, even mark-to-market, and features that in a benign origination environment or credit environment. So when you think about 2010, 11, and 12, when you're coming out of the Great Recession and you're originating loans into a early recovery, feeling pretty good about your your credit marks and your repo lender. You're looking at it saying, well, I've got 3 years of term. I'm making loans where my values are really depressed. My values are going to pop because the economy is coming back. Too much brain damage to do a CLO. It's too complicated. And certainly, as Darren pointed out, the delta between what an advance rate from a bank looks like and the cost versus what a CLO in 2011 might have looked like were pretty great. When you fast forward to now, we are in a much later stage of the current cycle. The credit environment is no longer benign. There is still a good amount of repo available, but things have changed. And I think for established players like Joan and like Gene, they certainly recognize the value of having the balanced sources of financing, having a good mixture between bank lines and access to the capital markets, and having that brand.
Another great segue. So even though we didn't set this up, we probably would have. Let me throw it out to Gene and Joan then a little bit, which sounds like why, other than the fact that you get to work with folks like me and Jeff, why do a CRE CLO and not just have the not use repo financing?
Let Gene go.
Yeah, I'm sorry, Gene, go first. Thank you. I always do ladies first. I apologize.
I think it's back to the balance issue that Kunal was talking about. I think the reasons that we do CRE CLO issuance and the reasons that we do bank warehouse borrowings are not one and the same. It's not the same type of borrowing. With the banks, regardless of how the docs are drafted, it's subjective. And, in a benign credit environment with liquidity, it's probably not not an issue for a good originator to find credit. But when the market turns, then that typically dissipates. So we find it to be a very good balance to strike, to have a good mix between CRE CLOs, and banks, and to get back to the cost issue, because that's obviously what drives most of the business, right, is the return. And what we found over time is we did our first issuance post-crisis back in September 2012. And you've not really lived a full life, right? And so you tried to do a revolving CRE CLO in 2012.
That's an awfully good counsel.
That was amazing. But fortunately, the deal actually went surprisingly easily. Believe it or not, we found a pool of agnostic investors, which I think was the key. Because I think if you didn't come at it from a jaundiced perspective, it actually looked very attractive, and those investors have been very well rewarded for the risk they took. But it was a very different market then, and our view was if you invest in the platform to have CLO or securitization issuance over the course of time, you're going to be rewarded for that. And what we've seen with respect to pricing is that relative to a static deal, the delta between a static deal and where we've issued has just come in dramatically since 2012. And I expect it will continue to. I think investors, if it's the right collateral, the right platform, right structure, even on a managed deal, I think a lot of investors see little, if any, more risk there than a good static deal. So I think that, but the problem, frankly, I think the biggest issue is that CMBS is such a large, relatively liquid asset class. You have a lot of investors who understand or believe they understand real estate, and they're asked to buy, real estate products. But you get into CRE CLOs, are talking about structures where people are less confident in their ability to understand the structure. Maybe they haven't looked at CRE CLO so much. You have corporate CLO buyers, which is most of the market, but they're not real estate experts. And then you have real estate experts who, if they're in securitization, are mostly buying CMBS. So for a lot of people, I think on the investing side, it takes a bit more time to get comfortable with the CRE CLO. And I think that's also true on the banking side. I mean, the time, probably asked the 2-3 bankers on the panel, but the time, particularly maybe not so much today, but up until very recently, the time that would have taken them to do a single CRE CLO, particularly a managed one, they probably could have done 5 or 8 CMBS deals. And economically, it probably just wasn't even worth their while. But I think we're starting to see that shift in the market a bit. And I've gotten off point a little, but just getting back to the...
It's all topics we're going to cover, though. So,
but the balance, we ultimately just see CLOs and bank financing as two very different sources of financing and how it reacts to the market. One is longer term, one tends to be a little shorter term, one's objective, one is subjective. They're very different. And I think a great time to do an issuance for a CRE CLO is when it's easiest to get repo financing. A lot of people don't do it then. They say, well, it's easy to get the repo financing, and that's normally in a very liquid market. I think that's the very time you should be issuing a CLO. Because when the market backs up and the bank's no longer available, that's the time you're going to be locked out from doing a securitization. But anyway, that's how we see it.
Yeah, thanks, Gene. Joan, from your perspective, do you look at the two differently, or are there advantages if to doing the CRE CLO rather than just the repo?
It's really the last point that Gene made. For us, it's about diversification. We don't want to have all our eggs in one basket. We very much appreciated Wells being one of the first ones in the market to offer us a term facility for this stuff. And it is a 3-year term, and the loans are 3-year loans. So typically they do pay off. And sometimes they pay off early, which is a lot easier when it's a line as opposed to a CLO. But we felt the need to diversify. And, as we became a repeat issuer and people got comfortable with us and got to know us, the whole world is now offering us lines. So we could have 6 lines and never need to do another CRE CLO. But as Gene said, when the market turns, you like to have a public vehicle. And maybe when the market turns, that won't be available to us, but at least we will have financed some of our loans there. But at the same time, a lot of other loans are paying off, so, it's a constantly rolling process.
Yeah, and when we're out talking to potential issuers about issuing, the biggest pushback is cost, and they all say, well, not all, but many say I could get cheaper financing through the warehouse lines, and it's amazing how short people's memories are, because they think, in many cases, a lot of issuers think that the repo's going to be there, through good and bad, and we saw during the last cycle, certainly repo had a mark-to-market provision, and many lenders took advantage of that mark-to-market provision. Certainly the guys that are still around, many of them really are primarily still around because they had term financing, non-mark-to-market term financing, non-recourse financing through the CRE CLO, or at that time it was called the CRE CDO. So, if I offered a warehouse that was non-recourse, non-mark-to-market term financing, but I would charge 25 bips or 50 bips more to a mortgage originator, you think guys would jump at it. But generally, they haven't, and now the pricing is actually much wider than that. The difference in pricing between warehouse lines and where you could do a static CLO today is certainly much wider than 25 or 50 basis points based on some recent prints in the market.
I want to say one more thing based on that. I mean, we do know pretty much what our rate's going to be on the warehouse line for this kind of loan, that kind of loan, this kind of LTV. And you don't have any idea what it's going to be at the time you come to market with your CLO. So you can get killed in the CLO market. On the other hand, Chuck asked me before, it's like, well, but the warehouse line's a recourse and the CLO isn't. So there is that. But we always look at it, number one, it's our name on there. Number two, we own the bottom 30% or 20%, depending on the deal. If a loan goes bad, we're going to take it out of the pool if it's a CLO. So it's the same as having it be recourse.
Jeff, Chuck, did you want to say something?
Yeah, I just want, I think the answer to, what are the advantages or disadvantages of your warehouse line or the CRE CLO depends on what kind of warehouse line you have. And the bigger guys or the smaller guys at both sides of the spectrum probably have a little bit of advantage, because if you're a large player and are able to negotiate the type of, facility that I think in three is, again, mark-to-market recourse and term, that has term, doesn't have mark-to-market, or has some kind of credit mark structure, and you've minimized your recourse, then maybe it doesn't make any sense. You have a perfectly ideal financing construct already in place, and the smaller guys can, go to the regional smaller banks and get a $50 million line or a $70 million line or whatnot. They don't have those kind of capacity concerns. But for everybody in the middle who are using repo financing, 1,000% agree with stuff that's already been said. Again, it comes down to market, recourse and term. And those lines will go away as soon as the market turns.
Are you offering non-mark-to-market?
We are not.
Term. I would just tell you that the market, right, we negotiate a ton of repos. The market is not going that way, it's going the other way. I mean, you saw non-mark-to-market, right? You saw credit market, stuff like that when people were selling assets and doing seller-based financing, but I don't think the repo market is going that way. Jeff, I would just ask you, so we're talking about, you talked a little bit about REMIC or CMBS versus CLOs. What's the advantage, if you're from a legal perspective, what are the advantages that you get from doing a CLO versus a REMIC or vice versa?
Sure. So, REMIC, try to keep it away from being overly legalistic, but a REMIC is a feature of...
don't know what a REMIC is. I'm not that worried.
REMIC is a feature of the tax code. Basically, the tax code says that an entity will not be subject to entity-level taxation if it meets a couple of criteria. And one of those criteria are, number one, that it's a static pool. Number two, that it has qualified mortgage loans. If you meet those those qualifications. And a REMIC is a very efficient vehicle because the vehicle is not subject to entity-level taxation. All of the securities issued all the way down through the non-rated are considered debt for tax purposes.
They can all be sold as opposed to the QRS deals, which are retaining, the below investment grade.
Correct. No reason to agonize to distinguish between debt versus equity. On the flip side, if you're going to use the CRE CLO, so as you pointed out earlier, that's essentially a corporation. Corporation can essentially engage in lots of different types of activity, primarily governed, in this case, number one, by what investors will tolerate, number two, what you need to qualify in order to remain exempt from entity-level taxation. So the CLO gives you flexibility as a corporation to have a ramp-up, to do reinvestment, to own assets that are not strictly commercial mortgage loans.
And especially when we're talking about transitional assets, there may be more discretion, there may be issues, LTV issues for REMIC. You're saying you can put more different types of assets in a CRE CLO.
With different types of assets in, is correct. In fact, we did a CLO early on. It was just mezzanine loans. Mezzanine loans would not be eligible for a REMIC. We haven't seen that return. We haven't seen any of our clients putting any mezzanine loans in, but that flexibility remains there. The flip side with the CLO is, in order to remain exempt from entity-level taxation, either it needs to be structured so that it's a qualified subsidiary of a REIT. So REITs are generally tax exempt as long as they're giving out 90% of their income in the form of dividends. So therefore, if you set up an issuer as a qualified REIT subsidiary, you're also going to be exempt. The issue there, the con there, is that all of the equity in the vehicle needs to be owned by the REIT. And that kind of brings up a question of, okay, well, what is debt and what is equity? In that case, we generally have guidelines there which basically we draw the line at investment-grade securities. So the REITs that you see that are doing CRE CLOs, they're all retaining all of the below investment-grade securities on their balance sheet. Now that is okay for many of the REITs because they're doing this as a financing tool. They're not interested in what you see in the CMBS world, where issuers want to kind of get out of the loan in its entirety.
Do they have the flexibility in because if it's done as a financing tool, would Gene and Joan have the flexibility to prepay the structure versus, say, a REMIC?
Yes, absolutely.
Most of the deals have a
structure. Correct.
Yeah.
Correct. In fact, the deals do have a provision in there, optional redemption, that allows the holder of the equity to prepay the deal.
Gene and Joan, when you guys are looking at these structures, is that an important feature, the ability to call the deals or, to buy, as Joan was saying, buy defaulted loans out of the deal, as opposed to going through the special servicing process necessarily?
Well, first of all, we're the special servicer of all of our deals, right? And we would control the workout. But yes, it's very important to us. As I think Darren mentioned it, there's sequential pay. So, and these are transitional loans. So sometimes borrowers are realizing their plans early. We have a lot of lockout in our deals, but not full lockout. So you're losing your cheapest source of debt first. So clearly, there's going to be a point at which you want to call the deal.
Gene, is the call important to you all?
It is. The analysis for us is probably slightly different because we have all 8 of our deals have actually been managed deals. So typically, the call more or less correlates with the end of the reinvestment period. We now have about 36 months for reinvestment period, so the call doesn't miss that very far. But it's vital to be able to call it at or before that date because afterwards it then goes static. And when it starts to delever, it gets back to the issues everyone else has raised. The return just suffers greatly, and the deal just is not economic at that point. So you have to make certain we have the ability to do that. And then regarding the defaulted assets, that's something that's vital that we have the option to buy those out because we, frankly, for reputational reasons, we want the ability to keep the pools pristine. I think Joan mentioned that earlier, but that's a very important
although I should point out, as both you're and Joan's lawyer, you're under no obligation.
Well, notice I said the option.
And investors should not rely or depend on any such...
Can I make a forward-looking statement there?
No, but but it is an important option to have that, is an
You own the equity too, right? So it's much easier to take the loan out of the deal and do what you need to protect your equity than it is necessarily to do it within the structure.
Well, our view is we own the equity, so if there's a loss to be suffered, we own it either way, whether the asset's in the pool or whether it isn't. So, it's easier for us if we had that situation, which we haven't had.
I think there's a question up front. Have deals been called? Have we seen deals get called?
We had 3 legacy vehicles. We redeemed all of those at par, and I would point out not one bond picked ever in any deal. Our first deal, some will find this amazing, but I think we ended up with 80% subordinate debt, 80% in our first vehicle, and not one bond picked, and they were redeemed at par. All the bonds were redeemed at par, and we had less subordinate debt in our second and third legacy vehicles, but neither of those ever picked. All the bonds were paid at par. So if anyone tells you this market is just a bad market, there are deals that have performed very well. And we've had 2 deals, actually from 2000, one from 2012, one from 2013. We also have redeemed at par, which means we have, 3 outstanding. So we've actually redeemed 5 of our 8 transactions, 5 of our 8 deals. Sorry?
No, he said it's par. It's still par for the.
Oh yeah, it's
Darren,
par.
is there something you wanted to say?
Yeah, one point that wasn't made is one big difference, I think, between REMIC vehicles and CRE CLOs is that, just CLO technology in general, is there's 2 forms of credit enhancement in a CLO. You have the subordination provided by the classes below, and you also have excess spread. So in a CMBS transaction, the excess spread is sold off at the top of the waterfall and paid carry with the AAA classes. And in a CRE CLO, that excess spread is paid at the bottom of the waterfall. So it's there to support the bondholders, the offered bondholders on every payment date. It's also used if there's an over-collateralization test embedded in the interest waterfall. It's also used as another form of deleveraging. So if that over-collateralization test trips, the excess spread that would have flown to the below investment grade classes and the equity is redirected and used to pay down the most outstanding class. So I think it's a feature that resonates with investors. Certainly, investors like to know that the issuer is only getting paid after they get paid, and it's also nice for investors to know that if the deal starts to subperform, the investors' returns will get impacted first.
It's a very good point. I would think that Chuck and Kunal, that having the sponsor at the bottom of the deal help owning those pieces, knowing where the incentives are a little bit as well.
Yeah, I mean, for sure, and I think later in the panel, but the collateral story in a lot of these deals is a lot hairier. We've talked about that already, transitional bridge loans. So, while I think the structural features and benefits of these deals versus REMICs are there, the fact that the issuer is generally holding a very large, significant risk piece at the bottom, which arguably is multiples of the true credit risk, a lot of investors still are focused on the credit. I mean, 0.45 cover loan, and you've got this road to getting to a 1.0 and all that, but they're looking at a bond they're buying, and I think the OC test is certainly a feature that a lot of issuers have used on static deals. It's obviously not something you see in a REMIC, and we certainly advise a lot of our clients, and I think the issuers on this panel certainly use OC tests because it's a powerful reinforcing feature that really kind of says, well, we're putting our money where our mouth is, and that's standing behind the credit that we're making.
Chuck, even on the deals, the bridge loan deals that have been done at CMBS that look more like CMBS deals, I think, have you seen, I think those deals are still, the bottom classes are being, or the below investment grade still get held by the loan transfer, as opposed to, it's no longer debt and it's true sale, but
I mean, I think if, we look back to, probably 2012, which were, the first deals in what we call CRE CLO space, a lot of them were REMICs when they first came out, right? I think you go into those league table databases and sometimes they don't know which way to classify a particular transaction because it's floating rate product, it's transitional in nature in some manner. The issuer is retaining the subordinate certificates, whether in pass-through form or in debt form. Is it a REMIC? Is it CMBS? Or is it CRE CLO? It's the same pool. It's just a different tax vehicle. So I think, the motivations and the incentives for the issuer, regardless of which way they go, and that still happens today, are the same.
So that kind of brings us to, I think, the comparison of 1.0 versus 2.0 or 1.0 versus 3.0 or whatever we're on. I haven't upgraded lately. I haven't my phone in. But I can recall as early as 2009, Gene, sitting with you and Jeff, talking about how things will be different when the market came back. And I, first of all, admired your optimism. Second of all, appreciated you paying for drinks. But are we seeing a difference? I assume we have a difference in what the deals look like a little bit. Where do we see the difference? How have things gotten better?
It's night and day difference. The transactions are not the same as what they used to be. I think if you go back and you were to look at our deals as representative of the market, which I think they more or less were pre-crisis, maybe there was a bit more complexity in some of ours, but marginally more, I would say. But the deals were, if you really read through the indenture and really understood them, and I don't know who did, frankly, what investor did, but they were incredibly complicated, nuanced vehicles. Probably more so than most people even today understand. They really were. And when we first sat down and, started talking about, when the market comes back, maybe with a little bit of optimism, but when the market comes back, how will a deal need to look to get done? I think what we ultimately settled on was make it as simple as possible in terms of the structure. I'll talk about the structure first and then maybe the collateral next. But in terms of the structure, I think the overarching theme is one of simplicity and transparency. The old deals were extremely complicated to understand. The new deals are the polar opposite. You couldn't have a simpler structure than at least our deals, and probably most deals that get done today, I would imagine, but certainly our deals are extremely simple to understand, and that was by design because we wanted to be able to cater to someone who knew real estate, wanted exposure, but was not even a structured finance buyer. And you could sit down and in 60 seconds or less describe the structure. They could go in, read the document, understand it. And I think that we achieved that. In fact, I'm sure we did because our buyers range from those who are heavy structured finance buyers to those who had never bought any structured finance paper ever.
Well, we're sophisticated investors under the securities law.
Extremely knowledgeable investors. But, yeah, they hadn't bought any structured product. And the structure is very simple to understand. And we did away with concepts like maintain or improve, lateral quality test. All those are not even in the document. They don't even exist in the document today. So it's an extremely simplified, streamlined document. In terms of the collateral, as I mentioned a moment ago, we had up to 80% subordinate paper, including PE, mezzanine, B notes, whatever you can imagine in the old deals. And today, virtually 100% of the deals, the collateral in the deals has been first mortgage product. And in our deals, it's been probably on the average 80% or so multifamily at that. So the collateral is very different today. We probably had, maybe we had 10%, 20% first mortgage, maybe 20%, 25% first mortgage multifamily product. Today we have 80%. And as Darren pointed out early on, capital structures are very different today. We had 91.75% leverage in our 2006 vehicle, which had 20% subordinate paper, by the way. Today, with 100% first mortgage paper collateral, we get 75 to 78% leverage in the vehicle. So it's just very different. There's less leverage. The structure is totally different, very simple, and the investors are much more comfortable with the collateral.
So, Darren, when you brought Bob Ritchie in your office and put him to work and trying to come up with CRE CEOs, paper was a little bit different, like Gene is saying. What do you see from your seat, seeing some of the differences?
Well, we were certainly very sensitive to what investors' concerns were with regards to legacy commercial real estate CDOs. Certainly, we spent a lot of time with large, sophisticated investors to understand what their concerns were. Before we brought our first transaction, we worked very closely with Resource very early on in 2013 in creating a very simple, static, simple, very transparent, clean structure that hacked off all the excess optionality and tests and things that really investors were concerned with. And we created a structure that, for all intents and purposes, looked a lot like a CMBS transaction. The idea was to create something that was as good, if not better, than a CMBS 3.0 deal. So what we did was we incorporated really the best practices from those transactions to do 3.0 deals. So we incorporated CRE reporting. So legacy transaction CDOs reporting was sporadic. It wasn't uniform. Certainly was problematic if you wanted to trade the bonds. We corrected that with the CRE reporting. We incorporated an operating advisor into the transactions like CMBS does. We incorporated change of control provisions that work in a similar fashion to a CMBS transaction. In addition, we've added things that make, I think, the CLO structure even better and frankly more robust and more investor-friendly than CMBS. And some of those features include step-up coupons that step the coupon up if the loans extend beyond a certain period of time. Many of the issuers waive special servicing fees on their transactions, so certainly that's helpful for reducing loss severities. So there's certainly a lot of different features we put into our transactions or suggested to our issuers that they put in their transactions to get investors comfortable. We also did that on the managed transaction that we did for Latitude. That was a 4-year replenishment period. Again, we spent a lot of time with very large, sophisticated investors, and the idea is to create a product that investors are comfortable with, that issuers can rely on for a source of financing, and not try to do a transaction that really was too cute. And I think, a lot of the legacy deals were just that, and I think a lot of legacy issuers took advantage of those features, and to the detriment of some large, sophisticated investors that don't forget. And certainly credibility is really important. And, to this day, we're on the road, we'll walk into a meeting, and, if the issuer was a good actor on their prior transactions, it resonates really well with some legacy investors, and they really appreciate it.
Jeff, I'm sorry, Joan, go ahead.
I want to add something, too. I want to put on my investor hat for a minute, since most of you know me as an investor. It's really important to me that these deals have a huge amount of transparency. I mean, we've all been talking about how complicated these loans are. They all have business plans. In order for people to understand what we're doing as lenders, they have to understand what we think the business plan is, which comes from the borrower. So there has to be a lot of disclosure in the term sheet and the Annex A that will help investors understand what we're telling them. So we try to make the description really robust. And I've seen that most other issuers have done the same. And I know there are a lot of issuers and potential issuers in the room, so I'm going to scold you. Don't go back. I've seen a deal recently where the disclosure was really, really thin, and it really infuriated me. It's a slap in the face to investors. Try and sell them a transitional loan and not tell them anything about it. So
Yeah, I think it's interesting to see the development in 1.0 because it came out of the ABS CDO market where there was no discretion. You basically were buying on, the name of the manager on a black box. Jeff, what are you seeing? You see all the papers on these deals. What do you see as the differences?
I think pretty much what everyone has said. I mean, the idea of keeping it simple. I guess at the risk of slight exaggeration, I would say that investors, so the impression that we have is that we're designing the deal so that the investors are investing in the loans, not in the manager. And when I say that, obviously, our issuer clients have their good, strong reputations in the market, and that goes a long way. But in the 1.0 market, the feeling was you're investing in the manager, and the manager has discretion, there's discretionary trades, and there's a reinvestment period, and there's a ramp-up period. So how much does it really matter? And how important is it for me to describe to you what the original pool is like if this pool can completely change over the course of the next 9, 12, 18 months? And therefore, there's a different scope and much different perspective in the disclosure. This time around, we're really treating the deals as an investment in the loans. And in fact, in many deals where we have like almost like a modified form of a ramp, which is where we have loans that are not yet closed, but we know we want to put them in the deal. We have actually gone as far as writing descriptions for loans that haven't closed. As long as they're far enough along that we feel pretty confident that this is the general structure of the loan, it is the general terms of the loans, we're actually putting that in the paper so that investors can see what is going to be in the deal, because that is really what they're investing in. That's what they want to invest in. They don't want to invest in the brand, although obviously the brand is meaningful. They want to invest in the loans, and they want to see what the loans are.
So you see all the deals that come out. We all reverse engineer what's coming out. I would ask Chuck and Kunal, from your perspective, some of the things that we don't see right now. We've heard from both Darren and Gene about some reinvestment period, but discretionary trading, mixed asset type of buckets, whether it's mezz or B notes, etc. Do you see, whether in the short or the long term, some of those techniques, whether really the first one would be the reinvestment period or a ramp, do you see the potential for those to come back?
I mean, I would say that, the premise of CRE CLO 2.0 is a pretty simple one, right? They're primarily financing vehicles for first lien mortgages concentrated in the 4 major food groups. That's what they are. So it's floating rate exposure to office, retail, multi-industrial. You'll see some hotels sprinkled in the deals. And you kind of compare that to 1.0. The average 1.0 deal was managed. The average 1.0 deal had a lot of bonds and loans, mortgages, sub-debt, TRUPS, REIT papers, CMBS. There's all sorts of things in those deals. And so if you're an investor, how do you get your arms around that? How was it rated? So it's a completely different animal. And by the way, a lot of that stuff was not originated by the issuer. I mean, both issuers we have at the table here originate loans. They like the risk they're originating. They're keeping the thick retention piece, and they're financing themselves through the capital market. So it's a completely different animal. And then on the reinvest, I think that there's a difference between doing it because you can do it and kind of get away with it versus doing it because you kind of need to do it based on the profile of the loans you're originating and just the economics. And not to speak for Gene, but I think he would tell you that he's run the math and analysis a gazillion ways.
When you're advice to counsel, you can't speak on the subject.
But my guess is he would say the static doesn't work.
Yeah, look, I mean, I think, Gene's experience was probably replicated a couple of years later with a couple of other guys. And, there was a deal in the fourth quarter a few years ago that had a revolving period before Latitude came out. And there was another deal that probably fits better into this bucket of stuff, right? Things that go beyond mortgages and include bonds or whatever. But and I didn't work on either of those, so I'm just repeating what's been.
Deals are happening.
Yeah, that they've happened, that they only happened because of a direct dialogue with the ultimate investors that permitted those structures to actually occur. But
let me go off script a little bit, because you guys are talking about direct dialogue with investors, and I want more deals. And for more deals, we need more types of assets. I don't like reinvestment because that leads to less deals. But let's deal with the same issue right there, and I know we'll have more issuers who come out. Why not? Like, if we have good transparency, Joan, if we've got, Chuck, if we've got good assets, why not have discretionary trading, or at least a bucket for discretionary trading, or at least have some mezz loans or go into B notes if people are able to underwrite it?
I'm not going to say never, and I'm not going to predict what we will do. I will just say that we have been very happy with the static deal market, as we have done in the past. I will not say that we will in the future, but we have come to market roughly twice a year. That works, and we like being able to talk to people about a very simple stuff.
It's worth it's worth the give on that for the relationship with the investors, so they understand what your product is.
Obviously, our cost of financing was attractive enough that we wanted to do it.
That's right. At the end of the day, it's materially cheaper if you have call protection to do static deal. It is just materially more expensive to do a managed structure, so it's really about economics at the end of the day, and certain issuers don't provide call protection, don't have call protection or very limited call protection on their loans. They have really no choice but to do a managed vehicle. While there's some issuers that are very clever at originating and have a very strong origination platform, and they're aggregating a pool of loans in a very short period of time to take advantage of that call protection. They come to market with static deals, and those things work really well. But it's about economics.
I would say there's only a handful of issuers out there who could actually get a reinvesting deal done. There's a lot of institutional investors out there who simply will not buy the bad B word, blind pool. They just don't want to deal with it. They've been burned by it, and unless you have a lot of really good things going on in a super tight box, similar to what the program Gene's running, really hard. But I think for a newer issuer, it would be extremely difficult to get a reinvesting deal done.
You guys touched on this a little bit before, and maybe this dovetails. I throw it out to the underwriters. Where are the investors coming from? Because all three of you we've done deals with, and we have discussions about the CMBS bid or the CLO bid, and they seem to be coming from two different places, right? The CLO person understands and wants to know why there isn't this or that, and the CMBS people want to come from the other.
It's a lot of the same investors, but I would say that for floating rate product, the depth of the investor market in CMBS 2.0 has been a little bit disappointing, but it tends to be dominated by banks. There's a lot of interest in banks, and the point I would make on investor demand for CRE CLOs is there's a lot of haves and have-nots. People with more established brands and with structures and track record and a lot of things they can point to will generally have deeper investor bases for their deals on a programmatic basis. But, banks have been active for that product, not surprisingly for obvious reasons. That LIBOR-based product, good relative value, and conservatively structured deals with tons of enhancement. It's tough to see yourself getting really hurt on a 50% enhanced bond with an OC test and all sorts of other things where the guy at the bottom is holding 20%. And then sort of, the deals for the most part generally have 3 or 4 tranches. The issuer is generally retaining below a agency BBB-. I think the liquidity and interest in that junior most class tends to be fleeting and depends by deal. There's not that many players looking at that. And I think it depends on the issuer, it depends on the deal, depends on market spreads and where things are trading. I'm going to defer to Darren because he controls most of this market.
No, Darren.
I agree with a lot of what Kunal said. I think certainly banks are a big driver of product, floating rate product at short duration. It makes a lot of sense for a bank. Insurance companies really don't look at it because it's fixed. We are seeing some interest from some European accounts. Certainly they like the fact that these bonds trade with some spread, with what is with the quantitative easing in Europe that tightened a lot of on-the-run products. So it got some attention there. Asset managers, certainly investment managers here in the States, like the product, but it's going going to take time, and certainly building an investor base that is comfortable with the product is certainly, I think, the biggest hurdle. The product really growing, and as Kunal pointed out, you really need a solid commercial real estate platform to be a successful issuer. If the investor base gets any whiff of it's a trade, it's a structured product group of guys getting together to originate some loans and do a trade and take back some equity, it won't go well. So you really need the platform. You need a business. It needs to be an enterprise that has been there, or if it's a new enterprise, it's a group of folks that have a lot of credibility in the commercial real estate space, particularly with investors.
Just add one thing to that. We issued our first deal post-crisis almost exactly 3 years ago to the day. I mean, we closed it September 27th, 2012. In the last 3 years, as high as the hurdles are today, and they are, they're significantly lower than they were even 12 months ago. God knows relative to 24, 36 months ago. But I think we've just seen a continuation of a thawing in the market where people have shifted from jaded to perhaps agnostic for some. I think 2 or 3 years ago, you really had to go off the run to find some investors, not all, but some. And today, I think increasingly, both in certainly in Europe and in the U.S., I think it's opened up a bit if you have a real platform, and if the market settles in and the volatility diminishes, if that happens, I would expect we would see some more activity.
Well, let me ask you this then, Chuck. I'll start with you since you guys got to go last. Darren touched on this a little bit. We've got people in the audience who are potential issuers, and I'll ask the entire panel. What's your advice? Who's best suited to do a CRE CLO or some other type of securitization of?
Well, we've touched upon sort of the nature of the platform and the expertise to be able to source and understand sort of the transitional nature of the assets, but it's also understanding a lot of the tax implications. We've had a number of conversations with folks, just walking them through at a very basic level, because all investment banks have disclosure that we're not accountants and offer no tax advice, et cetera. But the REITs have a huge advantage because they automatically kind of fill a lot of the check the boxes, and banks and specialty finance companies that want to originate loans into a vehicle do not, because once you take the thing offshore, you cannot originate. Correct if I'm wrong. We didn't talk about it. I don't believe you can originate something into an offshore vehicle. I think that's a bad fact for U.S. trade or business. If you bought it, it would be okay, but you can't set up shop and just say, okay, I'm going to do a CLO. It's a lot more complicated than that. So starting from the very, very beginning and understanding that, that's why most of Darren's clients in the market are REITs, right? And for the new guys, who are not REITs, it's absolutely still an open market and a competitive space that people should, continue to look at, and we hope that they continue to look at to create more business, more deals for, both the attorneys and the banks and, of course, the investors to buy the paper. But it really comes down to, again, the platform, the strength of the real estate, the story, and then just the knowledge of understanding how you get from point A to point B.
No, any thoughts on that in terms of?
No, we've covered it. I agree with what Chuck said.
Joan, you gave a little bit of advice before about transparency. If you were to give advice to somebody who was looking to go ahead in your position, any thoughts what a couple pieces of advice might be? Don't do right competition. Don't do it.
Exactly. Well, there was one thing that I didn't mention, and I don't think we're going to get to it, and that's on the servicing side. I think the transparency is not only in the beginning of the deal, but I think it has to go throughout the deal. Because, again, these are transitional loans, and investors need to know that the borrowers are actually achieving their business. So, whereas in a CMBS deal, you only hear how it's going once it's become a specially serviced loan, and you start getting reports from the special servicer every month. I think that issuers of these deals, it behooves them to report to investors on a regular basis what's going on in these. I'll just say we're doing that? Sure.
Yeah.
So we do that every 6 months. We don't have to, but we do, and I wish everybody else would too.
Again, you're under no legal obligation to do that.
I am not.
So in 1.0, we had a lot of, going back to the two men in a Bloomberg or two people in a Bloomberg, we didn't have a servicing shop. Does the panel think that, that's a helpful thing for the issuer itself to be servicing the loan? We've seen a number of deals where third parties are servicing as well. Yeah?
Yeah, I'm not out there marketing the bond, so I don't know how investors are reacting to it, but you're correct. We have seen it done both ways. I would think that, well, I'll leave it at that.
I was to say what's important, really, just looking at the servicing is that people understand what their obligations are, whether it's a third party or whether it's the issuer themselves. As Joan said, and Gene has touched on before, the servicing is, these are different types of assets, right? And it's important to have servicers who understand these types of assets. And I was talking a little bit about some of the differences at the beginning. That's going to be important. I think it's been important in 2.0 versus 1.0.
Yeah, I certainly think it's important that the issuer is able to demonstrate that they understand the loans and they can monitor the loans and administrate the loans. And if they're using a agent, effectively a sub-servicer to assist them in that, I don't think that's a problem, as long as they demonstrate that they still have the breadth of the platform to be the directing holder effectively and make the right decisions with regards to assets that do get into trouble in special servicing. Many of these guys that hire some special servicers really retain any subjective decision making, and they're really just hiring the special to do more of the administrative aspects of the special servicing.
Yeah, I'll ask one more panel question and we'll open up for questions, which is, are we seeing any new investor concerns? Are there things that you're seeing now or differently than 1.0? Certainly we've talked a little bit about some of the issues that we had in 1.0, but are you seeing concerns? Where are the investor concerns? Is it over structure? Is it over collateral? Is it over both?
Again, it really varies deal to deal, issuer to issuer. I mean, if you have an issuer who has a long track record and you can point to 6, 7, 8 deals over a period of time through the cycle, and that these are the originations, here's how they perform, that's one thing. But for a first-time issuer, there's a real challenge in marketing that deal, right? Because, it's a two-pronged process. You first have to establish the platform of the issuer. You have to get the investor to buy into their story. What is their infrastructure? Who are their people? Do they asset manage? Do they service? Once you get past that, then the next step is collateral and structure on the specific deal. And, we are at a point in the cycle right now where I think a lot of the bridge loans in these pools, there's more hair to them. It's not a bad thing necessarily, but there's more story to them. And so we're seeing, deal to deal, depending on that whole bridge light, the bridge heavy analogy. There's some deals where there's very little discussion of collateral and structure, and it's kind of a little bit of a smoother process. Other deals where you're spending hours on the phone or meetings, back and forth Q&A on collateral level stuff. So I think it really depends on deal and issuer. No, I would agree with that. And 2.0 was a lot easier just because of the simplicity and transparency of the structures that were being used, whether REMIC, transitional floaters, or static sequential pay, CRE CLO vehicles. And you look at the banks and the money managers at the senior classes, or the money managers and the hedge fund kind of accounts that look at the credit bonds. Those types of deals are still going to be looking at, the things we talked about earlier. They're going to look at credit. What level of transition are these assets in this particular pool? Is there anything here that's binary that I'm not going to, really have interest in and having any exposure? And then structure. And I talked about, the extension risk on floaters, and that's not different from CMBS, but we have a lot more flexibility, to help protect somebody who really wants just a 3-year piece of paper. And, so I think there's nothing really, I don't think yet, that's really that different.
think asset quality, as Kunal hit on.
And now for the purpose of my visit, Centurion, I'm going to roam on. We're looking at this picture now. I'm going to roam on leave, and custom decrees that I take Caesar a handsome present, something unusual and very valuable. What's that? Okay, so these are the men who are the soldiers for Caesar, and he works for Caesar too. I did think of taking him a present from Lutetia, maybe a marble memo tablet for him to carve down his appointments, but that's too ordinary. Then I had a brilliant idea. Why not take Caesar one of the invincible dolls from here up? What? But prefect, these invincible dolls, there's just one snag. Well, what is it? They happen to be invincible. That's what makes them so valuable. Get me one of these dolls and you won't regret it. There's certainly one who's a bit more harmless than the others, Cacophonix the Bard. He often goes for walks in the forest by himself looking for inspiration.
They were talking about dolls, G-A-U-L-S?
Yeah.
Explain that
No.
to hear what a doll is.
It's not going to work right now. We'll do that later. Not yet. I showed him where they were from on the map, but he doesn't know where France is yet.
But they were also very mean people. They used to just try to destroy everything. Destroy their enemies and beat them.
Whoa.
Yeah, dolls were really bad.
That's not what
Large, sophisticated accounts that we've been going to and that have participated in size in the market are questioning, some of the recent loans that they've seen in transactions, and they're pushing back. And certainly, as the cycle continues, the issuers have to reach more and more to get to the same yield. So I think that's definitely a concern for investors.
So before I ask for questions, it occurs to me I want to ask two questions to everybody in the panel. I saw John Strain sit down before, so this is kind of a John Strain asked question. So I'll start with Kunal on the first side, and then we'll go back the other way. So Jeff gets to sit in the middle, pretty much, and Chuck in the middle, and Ali. So will we see more or the same or less CRE CLOs in the next year? It's got to be a one-word answer. More.
Barbarians.
More.
Savages.
I have more on my desk, so more.
Gene?
I think more.
Darren? Same, okay. Going back the other way, will we see more innovation in terms of including 1.0 type techniques, whether it is reinvestment, ramp, or more or less? Or more of the same, I'm sorry, we won't have less.
Virtually impossible to have less. I would say far more than one word, but I think if volatility settles down, I think you're going to see slightly more.
Jeff?
The same.
I would say more innovation, but not necessarily limited to just what was used in 1.0.
It's a little unfair to Canal because I cut him off on the first point. Everybody else has been editorializing. But no?
Same, and for some newer issuers or entrants trying to get into space, it may be less.
I'm going to open it up for questions. If anyone has any from the audience, I appreciate your time. Any questions? In the back?
There's plenty of it around.
Mohit Malhotra, I'm from Bloomberg. I just want to come back to the CMBS and
Something out of a butcher shop. Now back into ambush. And I give the signal, we attack the bar. Not up your nose, idiot. Oh, look, he's putting the parsley up his nose.
Falcons won 25 to 19.
Do you want to just look at pictures instead of read the whole story? So that's where this little boy who was hiding behind the tree here, see him running? He goes back to tell Asterix and Obelix that they got cacophonous. And see, Asterix and Obelix run, and they all go drink the magic potion, and they all go run to get the Romans. See everybody going to get cacophonous? And then, whoosh, they all come in. And see him doing swings and biffs and swooshes. See all that? Do you see the fight? Oh, look what Obelix is doing. He's swinging him around by his feet. Oh, but they already have cacophonous on the ship. See them on the boat? And there they are eating some more. And then the Asterix and Obelix decide they're going to go to the water and try and catch them. And they find a boat. That's a cool looking boat, don't you think? They get on.
What's that? Oh.
I don't know. They were Phoenician. They were Phoenician traders.
Phoenicians were the big traders in the whole world. Always, it was a seagoing nation.
Stephen, you nice. Oh, and they found pirates, as they always tend to do. Do the pirates like Asterix and Obelix? Oh, look at this. That's how they won that.
Wow.
What's that?
That's Caesar.
Ow. You can't put my hip there on my leg.
I can.
Was in the place before too.
Yeah. Oh, look. And they chased them all the way to Rome. And look, they're going to take baths. You see? They're in the steam room. Uh-oh. Obelix is going to do a dive into the bath like Cousin Ozzy was doing in the pool. Remember that? And then splash. He does a dive. And then look, there's nobody in there. Oh, and then this guy is giving Asterix rubs. And he's like, aw, because he didn't like the way he rubbed him. And look, they found this guy, and he's going to tell them where cacophonous is. And they look in there, but he's not there. But you know what they do have? They have food for Obelix. And Obelix likes food. You see him eating? He's eating some more. And look, now they found their way to the gladiator place. Do you think they're going to be gladiators? Yeah. So they look in there. And they do bombs. Oh, look, they found the Gaulish restaurant. And these guys are waiting for him outside. And they say, let's get him. And Obelix says, clonk. And then there's some more who are going to try and get him.
It is, whoa! Unbelievable.